Good afternoon, everybody, or good morning again if you're out west, and welcome to day 3 of our 10th annual Canadian Restaurant Investment and Leadership Summit. For those of you joining us again, welcome back. And for those who this may be your first time, my name is Jacob Mancini. I am with CWB Franchise Finance, your hosts for this event this week, and I'm also going to be your virtual MC for today, as well as for the rest of the sessions. Before we get started, again, apologies for those who have sat in on calls before on these sessions before. Do want to go through a few housekeeping items just to sort of maximize your participation in today's session. We have just over an hour booked for today's panel discussion and some audience Q&A towards the end. And just a reminder that you can submit questions throughout the discussion using the control panel, and we will do our best to address a few at the end. The session today is going to be recorded, and we will send out a link next week for that. As well, for those who haven't joined us before, we will also send a link out for our 2020 Canadian Restaurant Industry Review, which has some insight and data on this industry. And finally, at the end of the presentation today, we do have a short survey that we ask that you take some time to provide some feedback as well. So. Again, just maybe to reiterate a little bit of the background on this event, as I mentioned, this is our 10th Canadian Restaurant Investment and Leadership Summit, so therefore our 10th anniversary. It is, again, a different year this year, and we're not able to get together as we like to do, to network, to catch up, and to sort of learn and engage in that way. But we did want to provide some level of learning opportunity, of engagement opportunity, and some insight on what's going on in this very unusual year. And so we have brought together sort of 4 sessions over the course of this week, and we'll present them one a day. This is, like I said, our 3rd one, and we have one more at the tomorrow, and encourage you to register if you can. Before we get started, I also want to take a moment to again thank our sponsors for the event. Without whom we would not be able to put this on. Our platinum sponsors are the Chicken Farmers of Canada and Cisco. Our gold sponsors, Attitude Marketing, Cassels, and Smooth Commerce. Our silver sponsors, Hub International, Dairy Farmers of Canada, Samsung, and Sotos. And our bronze sponsors, Food by Gating Contractors, and Lavazza. And again, some special thank yous to the NPD Group for their as premier research sponsor, and special thanks to FS Strategy, who is a contributing sponsor for the 2020 review that we'll be sending out later today. So today's presentation, for any of those who have attended this event before, and particularly those who were around or at this event in the early years, you'll know that the sort of the concepts of investment and finance and growth and development really are sort of ingrained in the DNA of this event. And I think that those topics this year are, as important as they've ever been, right? Especially as operators are facing a whole new world today, and it's one that's really thrown off growth strategies, investment strategies for them. So we are going to take some time today to dive into that, explore how things, looked at the start of 2020, how this crisis has impacted them, and maybe some of the lessons that have been learned that will play a role, going forward. So I'm going to stay on today both as a moderator and provide a bit of insight on a couple of the topics today. But I've also asked a few others who are much more engaged and familiar with some of these topics than I am to sort of join with us. So on a panel today, I've got Mark Eaton, who is the Chief Development Officer from Recipe Unlimited Corporation. And Mark has been with Recipe for 19 years, and is in his current role leads all real estate, franchising, design, construction functions for Recipe and their brands. I also have Lee Jackson, Vice President of Retail Business Development at JLL. Lee did spend a better part of a decade actually developing and operating some concepts for Oliver & Bonacini in Toronto, and in 2016 transitioned over to the commercial real estate side and spent 3 years with Oxford, specializing in their food, beverage, and entertainment divisions. And since 2019, he's been with JLL, a global real estate brokerage, and co-leads their their retail tenant and landlord representation side of the business, providing real estate strategy and site support for over 150 retail clients. And finally, we have Larry Weinberg, partner at Cassels. And Larry has been in the business for over 30 years and has a practice that specializes in providing all necessary legal services to a number of restaurant brands, both at their company levels as well as at the franchising side. He started with Cassels in '97, and now the group is more than 20 lawyers across the country in a wide range of areas, including franchising, leasing, trademarks, brand management, and M&A advisory as well. Larry also serves as board of directors for the Canadian Franchise Association and their CFA Council. So, guys, thank you very much for joining us today, and also a special thank you, of course, to Cassels for their sponsorship of this session. So,
thanks,
welcome.
Thank you.
Thanks. So, why don't we start by talking a bit about growth and sort of what you guys are seeing and hearing out there with respect to that, especially in light of what's going on now. And Larry, maybe I'll start with you and talk a bit about some of the customers you work with and some things you've seen. How are things changing with respect to growth strategies? Are they more or less aggressive? Are they changing from a sort of franchise or corporate perspective? Like, what are you seeing out there?
So I think a lot of what we're going to see is what we've been seeing in the last few years. During the pandemic, some actual growth, opening of units, new units, has probably been on hold as people try and figure out what's going on with their business. I mean, it's not going to be news to anyone here that if many restaurant businesses are not doing well right now, and some are doing better than others. If you were already geared for drive-through, pickup, delivery, efficiencies at the chain level, then you're probably doing better than anybody who is geared for just sit-down dining with all the restrictions that are in place. And the weather is going to get rid of patio season anytime soon. But even brands that have done well historically and you expect to do well, like Starbucks, has announced closing of hundreds of locations in North America. But if you come through this all, you're a survivor, then probably you're gonna be rewarded, I feel, by a better day ahead, because there will be fewer around. Frankly, the people who survive this will be rewarded, and there will be room for growth. There will be pent-up demand for sit-down dining. There'll be pent-up demand for the takeout and delivery. And I've been around long enough to call this my fourth recession. All different kinds of recessions, but my fourth recession. And what I've learned, interestingly enough, is that franchising loves a good recession. Franchising does better in a recession than in other times. Why? Maybe it's going to be obvious when I say it, but people who are lifelong employees with a package, a severance package, and need employment, look to buy themselves a job in some cases, look to invest in a franchise or in a business for the first time ever, and they see franchising as something safer to invest in. It's a way to start a business. There was already a trend towards franchising corporate locations in the last 10 years. A lot of major chains sold off corporate units to be franchises, and I bet they're very happy they did right now. They spread the risk. Some of them were able to get off leases in that period to multi-unit operators. Again, a trend in the US and Canada has been towards multi-unit ownership, and that trend will certainly continue, and there's a lot more factors we can talk about why that will continue as well.
Right. Well, I'm curious about something you said there with respect to sort of the trend towards larger multi-unit operators there in the US. That's something, at least from my perspective, that's been happening a bit here in Canada too. Do you see that continuing to happen as well? Sort of more move away from more of that owner-operator mentality and more towards a sort of a broader ownership?
Yeah, absolutely. There are certainly brands out there who's in the US, and now it's coming to Canada. Yesterday I had Ken Otto on here from Redberry, 100 Burger Kings, 20 Pizza Huts, sort of unique to Canada, but very, very common now in the US. And I see that coming to Canada just the same. And in fact, it's a fertile market for that. You can look at perhaps a generation of franchisees who are set to retire, individual owner operators who will look for somewhere to sell. And so if you're there to buy those units up, premium, discount, I don't know, depends on what we're talking about in terms of the market. There's going to be, the next 10 years will be very interesting in that space, I believe.
Yeah, yeah, and I think we're going to circle back to that comment in a little bit. I think around sort of those acquisition scenarios and how that works. Just maybe Larry, one little final thing. Any of these strategies, behaviors that you're providing here, anything that sort of you think is unique to the pandemic itself, that's come of that, or do you think this again is all stuff that's kind of already been happening?
I think it's just accelerated it all. There were already restaurant operators looking at third-party delivery, looking at their footprints, the number of seats, that it was becoming unnecessary, and the pandemic has just, again, accelerated it tremendously. So one of your speakers yesterday said, and I wrote it down because I thought it was so good, that 10 years of innovation have happened in the last 6 months. Yeah. And, I'll repeat that, and, I didn't write it, but it's worth mentioning.
Sure. Yeah, for sure. All right, so Mark, you've got a bit of a different perspective, I suppose, on growth, right? As representing sort of the franchise side, or franchisor side, I should say, with franchisees. What have you seen from a trend perspective? As we've entered into this time and this environment, what are your franchisees saying? What are potential franchisees saying? What are you looking at?
Well, it's actually a very good question, Jacob, and we were kind of wondering exactly that early on during the pandemic days. So we being the size we are, we have a pretty good database of lead generation. So we thought we'd ask them instead of us trying to guess and understand the trend. So we actually recently completed a survey to all of our leads in our database and asked them 3 really important questions, which was, in the current environment, are you still interested in owning a restaurant? That was interesting, right? Over 50% still said yes, they are. So that hasn't changed their minds. Some have dropped off, of course, going probably too uncertain right now. But still, a lot of people still interested in this industry. Second question, if you were to invest in a restaurant, which would you prefer? A franchise new branded business, a franchise independent business, an independent existing business, or a franchise branded existing business? And wholeheartedly, what came back was existing or new branded franchise business. What that tells us is people believe in big brands. They have trust that we're going to do the right things from a safety perspective and have longevity in the industry. So that was really, really profound. And then lastly, if you were going to make an investment in a restaurant today, has your level of expenditure thresholds changed? And they have come down for sure, as we would expect. So what we took away from that is people are still looking for opportunities to grow, be their own business owner, and thrive. They prefer to trend to brands versus other smaller independent companies, and investments are shrinking a little bit. So kind of right on the mark, QSR, smaller investment type of businesses are really going to thrive right now.
Yeah. So that's a good point. I guess you're probably, would you say there's more interest in for that QSR, end of the spectrum, or full service, or is there still kind of a nice blend of those?
Yeah, I'd say it's still a nice blend, but we are definitely seeing the trend move to the QSR side of this, absolutely. And a lot of companies, individuals asking, will we franchise QSR brands that aren't franchised today, as an example, right?
Oh, I see. Yeah.
Interesting.
Yeah.
Obviously, the desire for bar-based businesses, drinking establishments, that's really kind of faded a little bit for obvious reasons. But we're seeing that shift for sure to QSR.
If I could just add, I would agree that QSR really is going to come out of this better than anybody else, just because of how they're set up for the new reality of being in the restaurant business, and that opportunity, be they new QSRs or established brands, new and upcoming brands, they should do well. Yeah.
I think it really, really, really hits that note of there's an element of trust with a national big brand that you can count on them and us to do the right thing in their 4 walls to ensure safe.
Yeah. Well, that was, and if you remember, for anyone who's tuning in on the first session on Monday, that was one of the themes we talked about, right? Is sort of this reemergence of brands, and in part because from a trustworthy perspective. And it's not just in the restaurants; it's in our grocery stores. It's all that kind of stuff. So that's an interesting observation, Mark, that I agree with. So. So maybe let's shift a little bit, because if you want to grow, you need sites, and if you need sites, you got to deal with real estate and landlords, and obviously there's a lot to sort of talk about and unpack as it relates to that. And so Lee, obviously this is a world that you have a lot of interesting sort of contact with and ideas around. What maybe to start, like, what was the general pulse for tenant and landlord relationships, specifically, I guess, in restaurants, or maybe just retail in general, and how is that looking before the onset of this pandemic, and maybe how have things kind of changed since then?
Sure. Thanks, Jacob. I think I'll speak to F&B. I think retail has been its own challenge, and F&B, there was a huge appetite sort of pre-pandemic towards F&B uses from landlords, specifically those with large projects and developments such as enclosed malls, power centers, mixed-use developments, looking to kind of future-proof those assets. Drive traffic, trial. Many of the retail centers were looking to take that F&B offering as a total GLA or mix from somewhere around 5% of the total leasable area, upwards of 20, and even beyond that for some of the major, more urban-centric developments. Major F&B projects and the allocation of space, like over the last several years, we've seen the delivery of some premium flagship assets. Again, looking to drive that footfall, that traffic, amenitize the project for visitors, occupants, residents, depending on the type of development that's in place. The high streets, on the other hand, they've been, generally impartial to their desire for F&B. With smaller independent landlords or merchant landlords, they're sort of seeking to obtain tenants from a rent-driven perspective in line with the financing obligations they have in place for that project, and not necessarily being impacted by the curation of a street. A few urban-focused landlords, such as Allied REIT downtown, have spent the last decade or more assembling assets in urban cores, and have taken an effort to curate and place make to put together a desirable tenant mix. And I think that's really triggered down in the entertainment district on King Street, where you see these major mixed use projects now being put into play. And down on Portland and King, Allied has got a few projects that have come that are anchored by Shopify. So they've created a really desirable node where they want to be, a cool street, if you will. And now you've got Canada's largest tech company that has really put their global HQ in that area, with two other projects that are coming online between the Well and King Toronto. So that's an example of curation and what F&B can do to drive things. So that's where the appetite was, in my opinion.
Right. And sort of maybe as a follow-up to that, sort of, what's your perspective on how sort of landlords have supported sort of F&B tenants through, this cycle so far?
Well, obviously 2020 has been a year like no other. The retail industry as a whole has been disrupted dramatically. It's kind of left many in the industry struggling to cope. And the support landlords have been providing to retailers and F&B tenants, I think generally as a statement, it's been fragmented, with each landlord kind of dealing with its own challenges depending on what their mix is, their asset mix. We're starting to hear reports of abatement concessions, tallying upwards of $300 million for some of the major institutions, and for some of the REITs, it's in the tens of millions of dollars. And that doesn't even include the deferrals, which there's some significant, questions and uncertainty whether that capital will be recovered. And that's not just F&B based, that's obviously retail based, and apparel has been a category that's been absolutely crushed. The categories that are doing well, that we all hear the reports of, grocery, et cetera, their rents haven't gone up relative to those increases. And they're creating a great narrative that their costs have gone up as well. So the new deals they're signing, we're not seeing an increase in the rent to create opportunity for other categories to get a better rent deal. But each landlord has dealt with supporting tenants in a different way. I think, there were subsidies and government subsidies that came into place. The Canada Emergency Commercial Rent Assistance aka secret. It was considered cumbersome, a little bit bureaucratic, generated complaints from both landlords and tenants. I think with the landlords being left with the power in deciding whether to participate or not, it really left F&B tenants at the mercy of the landlord's decision. And for some landlords, they applied it in good faith, and applicable tenants were able to take advantage of this benefit. For others, it was used as a bargaining tool. It was used to leverage information for rights or, take lease rights away. Some landlords outright refused to participate, and they were looking at that as, an opportunity to potentially take advantage of releasing a space that may have been under contract for some time, and develop in that space. It's been complicated, I guess, is the best way to answer your question, Jacob. Yeah.
Yeah, no, for sure. So maybe Mark, come back to you here on this. So again, when you're thinking about, again, from your perspective and working with landlords and stuff, so, again, there was lots of trends, there was things that were changing pre-pandemic. When you look at stuff now, so what are the things that you guys are sort of paying the most attention to, trend-wise or otherwise, when it comes to dealing with real estate?
Yeah, I mean, before I answer that quickly, Jacob, I just will say that, the size we are with over 1,300 locations, we have, over 850 unique landlord sets out there. And it took us a bit of time, but I want to applaud most of them for being supportive and understanding through this, because there was a lot of communication, support, sympathy and empathy with what we were going through. And it really, really kind of resonated with me that they wanted to protect the ones that helped them get where they got to, right? Which was kind of a neat concept.
Yeah.
So yeah, it was a definite work in process, and we made the commitment. PJ mentioned yesterday he had a good relationship with all his landlords. He dealt with deals himself. We made the commitment, even with the size of our landlord base, we were going to reach out to every single person personally, have that human touch, that conversation. And I think it was really welcomed and paid off for both sides. So I just wanted to say that. But with regards to trends for us, certainly with the growth in number of seats in the market, we did notice obviously volume reductions in each individual facility as that overall market penetration did grow. Certainly less rushes during those key periods, and then the lack of need for so many seats. One of the blessings that we have, and a curse, is that we've been around so long that we have a good footprint in a lot of communities across Canada. But a lot of those footprints are large, all right? You think about some of our big restaurants with 400 or 500 seats in them. Do you really need that anymore in every location, or is it just sporadic? So we were seeing a desire and a need to shrink our footprint. This pandemic has just accelerated that greatly. So yeah, we will be reducing some sizes, repositioning to markets to better situate ourselves to be competitive in a more smaller, efficient size box, both from a physical plant to construct, but also to maintain, operate all the costs that go into that day-to-day business. So absolutely, that's the change.
Yeah. I want to stick on that point about sort of redesigning layouts and footprints, because I think obviously Mark, that's restaurants and brands we're hearing are doing that all the time. So I'd like to hear a bit more about your thoughts on that as well. But even like Lee and Larry and I think it's a good conversation from our landlords or clients that you're talking to. Are they thinking about sort of redesigning their spaces, especially with all this new stuff coming online? Lee, as you were talking about downtown Toronto. So I don't know, Mark, maybe sort of start with you again, but be interested to hear what everyone has to say about that.
Yeah, I think for the most part, and we've just really started embarking on this over the last year and a half or so, but now it's really accelerated, of course. Most landlords we talk to are willing to work with us to right size on premises. Obviously, long-term tenant, they don't want to lose us to the neighboring plaza down the street. So those conversations are typically easier than we thought they would be, which is positive. But you have to work with what you have in play. So sometimes those downsizing or right sizing, as you might want to call it, are easier to do from a physical perspective than others, just on how that facility was created in the first place. So I definitely believe that we are getting some positive momentum there, for sure.
I would just add that I think a lot of it is dictated by just this new sense of reality. Landlords are, I think, prepared to work with and invest in brands they think have longevity and will survive this. And they've got to put out so many fires that they're probably not prepared to really work or do much for brands they don't think are going to work out or survive. And in terms of downsizing space, you know, that's kind of one space at a time. So it's pretty hard to generalize, but again, if they see you have a future, then they'll invest in you. I think, you know, landlords are traditionally not known for their being the nicest group of people to deal with sometimes. So this is a new reality.
Right.
For sure.
Yeah.
I'll just add, Jacob, I think it's an operator's market on both sides. And I think, you know, the tenants that are going to survive, you know, the recipes of the world that are large enough that they're going to continue on. There'll be some collateral damage potentially, but landlords are going to be competing, as Mark just kind of indicated to that. So I think the pivots that they make and how they better operate and design their spaces to accommodate the new restaurant realities. I mean, we haven't touched on delivery or takeout or curbside pickups, but I think the landlords whose projects reflect design changes on how you receive that type of service in the space, how you facilitate that ecosystem if it's digitally. CF Eats just was launched, and you know, it's infancy right now with mall traffic being down, but it's a virtual food hall that, you know, basically syncs all the aggregators that any operator is using in the space to create a more frictionless opportunity for mall traffic to engage with those brands. Those are going to be real differentiators, and from a landlord operations perspective, I think that's going to be very, very meaningful going forward when a tenant chooses to be in a place. How can you tap into some of the infrastructure that they've put in to maximize your sales and revenue?
Right. So Lee, you mentioned again before about talking about how there's a bunch of new stuff coming online, and you know, I think obviously a lot of these mixed use developments, you know, rely on F&B and restaurants to a certain degree. And I even in my presentation a couple days ago, I've sort of made some commentary around, you know, one of the challenges is kind of trying to figure out what market rates are right now for things, right? So when you look at, like you said, it's an operator market, a lot of new supply coming online, and obviously the uncertainty of what's going on. Like, what can you tell me about, or what are you hearing about, like what rental rates and market rates are like right now and what they're going to be going forward?
Yeah, it's the $1 million question, right? The short answer is there's very few comps to report to date. You know, what we're hearing anecdotally is on some of the retrades, you know, renewals, blend and extends, things of that nature are starting to give indicators of what a potential appetite from a new market will be. I would say and share that we're seeing sort of three phenomenons in the marketplace. There are a number of groups who are looking, you know, opportunistically for second generation space for restaurants that, you know, inevitably are going to go dark, and that inventory is being absorbed very quickly right now. We're working with some ghost kitchen operators, different franchise groups, and they're looking to create scale for their radius, and this is a cost-effective way to do it. While no one really is paying a ton of attention to the interior, you can keep CapEx, you know, very low, put lipstick on that space, and really plug into existing infrastructure and start to execute. So that is a market that I would say, you know, from a rent perspective, it's holding and potentially in some situations is becoming competitive to absorb that space, but you're putting minimal capital into those projects. Another market is, you know, suburbs and neighborhoods, you know, fringe neighborhoods. People are at home right now. It's anticipated that work from home will be a trend that sticks in a capacity, you know, be it, you know, 40% of the time or 60% of the time. Time will tell, but the fact of the matter is, with travel restrictions in place, consumer confidence probably wavering for 24 months or more on their ability to travel, and then, you know, the economics of that providing other challenges, the cost to do so, people are going to be at home more. So there's a shift in real estate desire, and there's less inventory in those marketplaces. So I would, you know, say and project that market rates will probably hold, if not again increase in certain situations there. Then you've got, I guess there's the central business district, and so that's maybe a fourth that I didn't have on my list here to touch on, but those are flagship sites, iconic locations that were tough to get into prior. And when the opportunities are coming up, I think there's an appetite for those because people recognize CBD will return, and those have been the highest volume restaurants in the country for the most part, especially those that fringe on financial district, entertainment nodes, things of that nature. And then finally, I think you've got the new inventory that you mentioned, right? There are a ton of developments coming forward, and that's the question mark there is, are landlords going to drop the rates and seek capital from the occupier, the tenants, to fit out these spaces? Or are they going to buy up the rates and help to turnkey that space to compete with the second generation marketplace right now? I think that's who's going to be hit the most from a rent perspective. But to hold values, they need to keep rents in place and would probably rather hold and wait for people to come back. Mark, I'd love to know your thoughts on those four sort of opinions I've shared.
Yeah, I think I echo them, Lee, for sure. We're seeing very similar trends. I mean, QSR drive-through sites have been and will continue to be in high demand, especially in suburban and smaller markets, as we've seen. Not a lot of big restaurant deals being done in the core of any major Canadian city right now, as we know. Thankfully for us, we have very little exposure in the big urban centers. We're more of a mid-tier, small market type of company, which has been great for us. But yeah, I think the one point you hit on that has really been on our top of our to-do list and chasing down is those guys that probably won't make it through. As Larry mentioned earlier on, the seats will decline in the marketplace. Who's going to pick those seats up? It is a lower cost of entry, and I think landlords will try to maximize their dollar for that for sure. We're definitely seeing those trends come through.
Yeah. So just a short anecdote. I have a client who's full service restaurant space and obviously not doing well. At some point had to be entirely shut down. He was able to find on a major thoroughfare in Toronto an empty restaurant, no one renting that space. So he rented it only to open the kitchen to use as a ghost kitchen. Not even going to bother renovating or opening the seating area. Just going to continue to operate under his brand as a ghost kitchen and picking up his business that way.
Wow. It's interesting. Yeah, again,
we launched our off-premise kitchen right in the middle of the pandemic in early April as well. We'd already started a process of making that happen, but timing was good from that perspective. Obviously, we learned a lot through the pandemic of what will work and why, and we're going to accelerate that brand. We don't like the term ghost or virtual because they actually do physically exist. You can see and touch them. But it's definitely an opportunity for us to get great product to customers hot, fresh, and quick, where we might not be able to do so in certain areas of the city. So definitely an opportunity for most.
And you're offering more than one brand out of that location, if I'm not mistaken.
That's correct there, yeah. So that the idea is it's a one-stop shop. You can mix and match your favorite menu items from each one of our brands and have one delivery versus multiple. Yeah.
Interesting.
One of the other places to watch is going to be enclosed mall. The demalling is something I keep hearing from different brands. Food courts are something exceptionally interesting to me, and I'm sure to you, Mark, but rates in food courts, as many who are on this call probably know, were just outrageously high and have been completely gutted of any traffic at this point. It's just not sustainable to think of any period of time they can go paying anything close to market rent when they're doing 5, 10, 15% of regular revenue. So how that plays out is going to be interesting. Those were near impossible due to a couple of groups kind of boxing out regional players by pushing those rents high. And I'll be curious to see if we do see some regional or smaller groups enter that category because landlords drop their rates, or if the big shops hold on to that space. I'm not sure what will happen there.
Yeah, we're watching them very closely as well. We have a big footprint in the food court, particularly with our New York Fries brand. That we really are the only game in town when it comes to that offering, which is great. And we are a good value play, so we've managed to be okay through this. But we have pivoted to off-premise delivery for that brand as well. It was launched in our Ultimate Kitchen. And the aggregators are now coming into the malls to deliver food from the food court to guests in their homes. So again, a very unique pivot there too. So for sure, something to watch closely.
Interesting. So we could talk about real estate all day long, I think, and I'm even noticing a couple of questions coming in that I think I'd like to circle back to during the Q&A, because I think there'll be some interesting stuff. But before I move on to some other elements here, maybe really quickly, guys, just any sort of quick hit ideas on sort of ways to maximize success, mutual success for both landlords and tenants in this environment.
Well, I'll start after the silence for a second there. We have seen some clients with existing brands creating new brands that otherwise don't exist to insert into their existing locations to increase their offering. And so I guess the goal there is to maximize, obviously, the footprint, and I can see that being attractive to the landlords if that's the point of the question. So, how to prove your longevity to landlords.
Yep, exactly right. Lee, Mark, anything? Yeah.
For me, Jacob, is just over communicate, right? Talk about what your plans are, articulate, what your needs are, listen to what theirs are, and try to find common ground. That's, for me, where we've seen the most mutual success, is just knowing what's important to each other and trying to bridge the gap and make something happen that's going to be mutually beneficial, for sure.
Yeah, I echo Mark's sentiments there. I mean, you've got to communicate with your landlord and vice versa. Landlord needs to communicate with their tenant. What you're communicating is key on how you're trying to shift and pivot and what changes you're making to try to drive revenue. I think again, showing that resilience is absolutely key. And this isn't landlord-tenant relationship specific, but it's more operator specific. But you've got to be on the technology train. You've got to highlight those functionalities and work with your landlords to better facilitate those changes. Having New York fries picked up from a mall is something that 7 or 8 months ago would have been absolutely non-starter, right? Mark, it's not possible. Having grocery be executed from a Joey's or an Earl's would have been a non-starter. And between everybody on this call, I mean, perhaps that comes back because there are grocery stores that might not like that, but that's an interesting dynamic. But you need to communicate with your landlord what pivots you're trying to make so they can help you to facilitate those.
100% agree.
All right, thanks, guys. So I want to transition now towards a discussion around some, maybe some M&A activity, consolidation activity that's out there in the market. But as this is a presentation or a panel discussion around many things, including finance and investment, probably makes sense for me to grab the mic for a few minutes and just talk a bit about what's going on, sort of from a debt and a lending perspective right now, if that's okay. So I do find myself getting a couple of common questions, I'd say, over the last sort of 7 or 8 months, and so I've sort of wrote them down here and want to comment on a few of them. One of them that I get asked a lot and certainly applies is sort of what the lender's view of the industry is right now. And I think the right way to describe that is cautious. And I say that for a couple of reasons. Like there's been obviously a shift in this industry, and for a segment that's always been viewed with a certain amount of perceived risk, and then suddenly has gotten a lot riskier, it does create some challenges for lenders. You couple that with the fact that every single sort of traditional metric of performance that you use to evaluate a transaction or consider something, has been completely thrown off. And that's all said, I do kind of keep going back to the fact that this is fundamentally not an industry problem. It's sort of a broader global crisis that's affected everybody, right? From socially, behaviorally, economically. And so if you layer that perspective onto this industry that's all things considered done pretty well over the last little while, even like QSR and pizza and their performance, some strong numbers in the full service, I think there's no question about the long-term viability here, right? And I think from a lender point of view, that does give us some comfort. I do caution, obviously, that there are going to be changes in appetite and approaches in this, and I think that they're going to play out along sort of that spectrum of this industry. At the one side, you've got QSR, which has done relatively well, and I think Larry, you were talking about this before about how like their investments in digital and off premise and sort of the creativity has really helped them to win on that. And then as you move down the spectrum in fast casual and into sort of casual dining and premium and fine dining, there are potential for some increased struggles there, size locations, labor commitments, menu complexity, and just the model itself, right? That creates some challenges. So I do expect that like lending is going to mirror that spectrum. QSR will be easier to get done, more comfortable, and then maybe as you move along the spectrum, it does become a bit more challenging, and having a bit more expertise will help to get that kind of stuff done in the end of the day. And I think that's the most important thing. The other question I get a lot of is sort of, how is all of this going to change how lenders look at deals and how they're going to be structured, right? And I think it's a really great question. And my view of that is that fundamentally, again, the standard metrics that we would have used before to evaluate an opportunity, just don't work anymore, right? And that's a challenge from a bank perspective, just because valuations, are what you're going to use to drive what you can lend. So the question is, like, if you can't look at current results because they don't make sense, do you go back to 2019 results or pre-pandemic results? Do you rely on projections, or do you take some kind of a hybrid of all those approaches? And my perspective on that, and I think it's the one that makes sense, is it's the hybrid that's going to work here, right? So on the one hand, you have a business that has stabilized values that are not really reflected in the financials and probably closer to where they were pre-pandemic. But on the other hand, you can't ignore the discounts or the length of time for recovery, right? And so I think that's how deals are going to get done, by sort of balancing structure based on a stabilized value and a payment plan based on sort of the rebound, right, and how things will recover, both from a sales perspective and sort of a cost perspective as well. And the last comment I want to make about that is I do think, again, borrowers have to be prepared for some adjustments in this, right? Like you need to, lenders are going to have a bit less of a tolerance for higher leverage and tight debt service. And so, I think you shouldn't be surprised if you see, maybe a quarter or half-inch turn less on your leverage than you might have had before, or, which means maybe having to bring more equity into a deal. I also think that you might see a bit more focus on balance sheets and then becoming a consideration. Investment lending is not historically a balance sheet lending model. It's cash flow based, and as long as you have the cash flow necessary to make payments at a decent ratio, you're in a good spot. But if you look at those who have survived and have been best positioned to survive through this, they either have been unaffected, QSR brands that have been relatively little affected, or they've had really great liquidity and working capitals to support. And so I think that might be something that banks will start looking towards. That, and this is not in the box stuff. This is, if you're stretching your underwriting or getting a bit aggressive, maybe some kind of minimum liquidity requirement or even extra security is going to play a role in that as well. So, so that's sort of the lending view, and maybe I'll come back and touch on some of that a little bit later as well. But let's talk a bit about M&A and some consolidation, because I think that's something where I'd be interested in hearing a bit more about. And Larry, I know you work with a lot of folks from an M&A advisory perspective. In this environment now, like what do you think this market's going to look like going forward?
Well, I think you've got a whole combination of things going on. You've got distressed sales. You've got chains that have gone bankrupt. A lot of this is out of the U.S. Not a lot of public information on bankruptcies in Canada as yet. There was a quiet period where PE firms, for instance, have a lot of money to spend. Strategic investors, perhaps like Recipe, have money to spend and are looking, well, what are we paying for? Are we paying for historical EBITDA? Are we paying for pandemic or future growth. And so money was sitting on the sidelines. I think just in the last few days, from what I've been reading, this deal in the US where Inspire Brands, which is a subsidiary of PE firm Rourke, has bought Dunkin' Donuts, Baskin Robbins in Canada is what they own, for $9 billion. I've read already that, so the cobwebs are out of the system, the clouds have lifted, this is going to be the start. But yet, even over the last 6 months, you saw Johnny Rockets for sale, sort of or sold for probably not a distressed price, but a get out while the getting's good price. And then that followed up with Friendly's, which was a sister company, which actually I think was taken through bankruptcy in the US by its parent, by its PE firm ownership. So you got a lot of things going on, but I do think there is, I just was reading again this morning, the market is ripe for a lot of activity. There are lots of funds with money willing to spend it, and now they're looking at opportunities. I see more consolidation. Companies with brands already are going to want to add more brands because they bring a lot to the table in terms of G&A expenses, savings, and technology, and the ability to implement that and do better. And so take good brands and make them great is what the attitude is going to be.
Yeah. I did find, that you're talking about the Dunkin' Donuts deal. I did find that kind of interesting that was sort of the first large transaction that's been announced since the start of this pandemic, and especially, Larry, to your point that there's so many U.S. brands that are sitting there available in the U.S. for sale right now. And do you think that part of that is just investment is not quite ready yet to sort of take a stab at some distressed assets that maybe they want to see how things shake out a little bit more?
Well, I'm not sure the sellers are prepared to sell at distressed prices. They can sit and wait, and they think this is going to blow over and that they don't have to sell at a distressed price. And buyers aren't necessarily, I believe, thinking that they're going to pick it up at a distressed price. Those are sort of cherry picking. But I think it comes back to what we said right at the beginning of this hour, which is if you're in a good shape because you are QSR or you dealt with pickup and delivery, you have the technology, or you're an up-and-coming new brand that doesn't have a lot of baggage in that way, like too big space that's too big, et cetera, then you're going to conquer the future. But and that will be the same in M&A, I think. Those are the brands who are going to be picked up and at a premium still. Right.
What are any thoughts on, you made a comment around how there's maybe sellers aren't willing to sell at a distressed price, right? So it suggests, I think, that there's going to be some gaps in buyer valuations and seller valuations in this, right? So any thoughts on ways to fill those gaps or how you think that might evolve? I mean, I look at that certainly and think that there's probably going to need to be more equity, or maybe even sellers have to be a bit more creative and maybe take some paper back, right, to sort of make deals happen.
Yeah, but I also believe that, yes, all of that. And I also believe that there's enough competition in the market, enough money to invest, again, especially in the US, but it should make its way here, that there's going to be competition for some of these brands. So people will, like they were doing pre-pandemic, probably in hindsight overpaying to get in, and then surprising themselves maybe and making a good business better and reselling it at a further premium. So that's sort of my suspicion or belief.
Right. And when it comes to acquisition in general, again, from your perspective, and when you consult and work with potential buyers of things, what are some of the dynamics or characteristics that you think an investor should be looking at, when they're trying to assess an opportunity, and whether or not this is a distressed asset or just an interesting opportunity, what are some of the things you think that people should be thinking about?
I think they're going to look at things like they've always looked at. Just how they play out now is different. The fundamentals of the business, unit economics, are the units making money, especially, in a franchise context. Private equity has, in the last 10 years, really fallen in love with the franchise business model. Not a lot of capital expenditures. Your assets are paper with a cash flow. and it's pretty steady, they're going to be looking to make sure there is that steady cash flow. So it goes back to unit economics and the fundamentals there. So it comes back again to how well are those units doing in this market, and can they survive and thrive?
Right. I was listening to this to a podcast recently, and they made an interesting comment around how, you know, one of the things that's really changed is that pre-pandemic, you know, there wasn't a lot of opportunity for growth, right, in an organic way, and you know, the traffic counts were pretty flat, and the markets were fairly saturated. And then, you know, obviously the pandemic hits, and for most estimates, you might see a loss of 10 or 20% of your unit count. And so all of a sudden now, you know, the idea of growing is back on some people's radars, and it wasn't there before. And I thought that was just an really interesting observation. And maybe that'll change some perspective, right? In other words, if you're looking at a brand that maybe you thought wouldn't have a lot of growth opportunity, maybe now it does. And I wonder if that changes some things.
Yeah, well, you know, I heard somebody say, you mentioned 10% of restaurants closing on a brand, and I heard somebody on another one of these panels a few months back say, think about that. That's 100,000 restaurants closing. Right. There's going to be a lot of empty space to pick up. You know, we mentioned the Dunkin' deal. The same week that Dunkin' announced it's being bought by Inspire, they also announced they're closing 650 restaurants. You know, that's just incredible to me, right? But that's 650 units that are going to be out there looking for new operators. So, you know, again, if you survive this pandemic, you're probably in a pretty good shape, because there is going to be a lot of room for growth and maybe reconfiguration. And, you know, I saw, maybe you showed it, this new look at Burger King. Jacob, was it Monday?
Mm-hmm.
I already lost track of things.
Yeah.
You know, basically the entire restaurant is a bunch of drive-through lanes and a kitchen. Right.
Yeah, with a whole bunch of like automation. Yeah, that is what right. that new look is, right? It's it again pushing towards frictionless, pushing towards you know, minimum contact and pandemic proofing some of these things.
Right.
So yeah. Sorry, Lee, did you have any other comments on there, or just?
I do. Just on the Dunkin' piece, I think it's a fascinating acquisition. You know, Roar Capital also controls Focus Brands. They have Jamba Juice, Cinnabon, NTNs, and while coffee and breakfast segment is really challenged, those are really nice conversions. You know, it's a bit of a real estate play, in my opinion, and you'll probably see conversions happen, but you put a really iconic brand in the US on the shelf for when, you know, consumer patterns return. So it's an interesting one, right? And I think you'll see groups looking at M&A from that perspective, is how can we take on a solid brand with scale, take advantage of some of the real estate in the near term and midterm, and maximize the value of this brand going forward, put it on a shelf for now and grow later. So it's a really fascinating one. I think it's the second largest acquisition in restaurant brand history, if I'm not mistaken as well.
Yeah, I think you're right, and that's a good point. You know, building more complementary brands, right? Like you said, so you know, have something that helps you shake up your portfolio a bit and maybe minimize your risk, right? So if in a couple of years, if that sort of breakfast piece comes back, then you know that could maybe offset what you've lost somewhere else. So there is some value to that. So
and just look at the power of that brand. There isn't one Dunkin' Donuts in this country, and everybody knows Dunkin' Donuts. There are very few Dunkin' Donuts west of the Rocky Mountains, I just happen to know. And so there's huge room for growth of that brand down in the US. I don't know if they'll ever try and come back to Canada because of Tim's, of course, but you know, there's a lot, and they're worldwide. There are lots of other countries.
Yeah, for sure. So one other thing here before we sort of move on to some Q&A, guys. Larry, we talked a bit about some of these brands that are available down there that have, you know, or in some level of receivership or bankruptcy declaration, and you know, I think I don't want to end this conversation on a sort of a down note, but I think restructuring is something that a lot of people wonder about. Maybe they don't quite understand a lot about, and maybe they're just afraid to ask about it. So I think, you know, curious to sort of think about what your perspectives on that are. Is it viable? How does it play out? What are some, how does that all look, or what are some solutions?
Yeah, so as I said earlier, there hasn't been a lot of public information about bankruptcies in the QSR or restaurant space in Canada. And in the US, it's all been tied with prepackaged sales. So someone enters Chapter 11, which is their reorganization type of bankruptcy, with the intention of immediately selling their business. But there are ways to use just the threat of bankruptcy as a way to right-size your business. We had a client that got exited out of a relatively large number of leases, bad leases in their view, simply by being prepared to go the equivalent of what we, Chapter 11 or CCAA in Canada, or bankrupt, because landlords know that if they go that route, then they'll get nothing. So it is a way, in the right circumstances, played the right way, to fix your business pre-pandemic and certainly during the pandemic, because landlords are more amenable, or they need to be more amenable. So so bankruptcy, or even just the threat, the real threat of bankruptcy. Anybody can say, oh, I'm going bankrupt, but if you actually, sometimes it's better to owe more than less in these kind of situations.
Interesting.
More on the table, more at stake, more to deal with,
right.
more to negotiate.
Right. Yeah. More discussion. Right. Great. Well, listen. So we're almost at 2 o'clock, and like I said, there has been a couple of interesting questions that have come in that I both sort of earlier on during the registration, but also as we've been talking here, and I want to address them because I think they're really interesting. So, one of the questions that came in was about, well, a couple of these are about real estate, but one of them came in was whether or not we might see a shift to more percentage rent arrangements moving forward, sort of as a way to share the risk in the space, or even, or they're suggesting, are there other alternative rent structures? So, Lee, maybe I'll start with you. Like, what are your visions, or what do you think might happen when it comes to things like percentage rent?
It's certainly been a way that landlords have provided support, I guess, to date. It's been a greater of model, and percentage rent. I think shared revenue has always been a lever. With new product coming online, I think it's going to be a way to potentially induce tenants into joining a project. I would be shocked if it's a permanent solution for landlords who are looking to increase the valuation of their properties. They need that fixed rent in place. So the concept of an 18 or 24 month revenue share that has a crystallization period and a minimum threshold would make sense to me, and I can certainly see something like that coming into play. There has been noise of JV models for full project food and beverage absorption, where you activate a tremendous amount of the space in a project, the food hall model almost, but spread out, and looking at some of the large restaurant groups that are offering unique concepts and taking a number of brands, putting them in place in one project, and JVing for something like that. For QSRs, I just think it's too competitive. I think a landlord will find somebody who's going to take the space and pay rent for it. And that's not the same across all markets, but I think as a general sentiment, QSR is too competitive right now for landlords to consider a percentage rent only deal for that type of use. Full service restaurant, perhaps. I'll maybe end it there and let Mark provide some color commentary on that.
Yeah, I'd echo that, Lee. I think, there definitely will be, and we've seen some appetite in the large urban centers as a Band-Aid solution in the short term, for sure. From an operator perspective, it makes a ton of sense for us. It's a downside protection when things may not be great, and definitely upside potential for the landlords when things do get better quickly, right? So there definitely can be a win-win there for everybody on a short and long-term basis, depending on the site, for sure. Definitely would welcome those conversations, as I know some landlords would as well.
Yeah, I'm for sure. All right, thanks. A second question that's come in that I actually had both received earlier as well as came in during this conversation. So more than one person is interested in it is lease renegotiations. So, any advice, any thoughts on those discussions? And I think in particular, this relates to scenarios where, maybe you're in an office building where the traffic is not going to be the same anymore or whatnot. Is there any, and this is for all three of you guys. I mean, any thoughts on, those types of conversations? Is that something that's worthwhile pursuing or having a discussion around?
I'll take the first step, Mark.
Yeah.
I think it comes down to what Mark and I shared earlier about communication. If it's something that you need and is required, then you most certainly should engage in that conversation, because the other side of that is that you're going to continue to struggle and business will no longer exist. So, have that conversation. It's not all space is created equally and not all markets are. So it's hard to say without knowing the details of who's asking the question. Certainly happy to connect offline if somebody wants to have a more intimate discussion about their situation. When it comes to office space, I think there's a general recognition in the CBD in Toronto. I know some of the path landlords have extended gross revenue percentage rent offerings to multiple tenants, if not all, in certain projects until the end of 21, recognizing the situation. So that comes with operating covenants, which is another operator consideration, because when you're doing 5% of your business, it might actually cost you more money to be open than closed. But if we all think this maybe comes back in May or June in the CBDs, then you have 6 months of upside potentially. So to close on that though, it's really case by case. I think all landlords are looking to make sure they hold tenants that they want to keep. To Mark's point earlier too, they don't want you going down the street. So I think there's an appetite to have a conversation if that's your situation.
I'll add to the anecdote I provided a few minutes ago, the situation where we helped a client right-size their business. That didn't include, so this is in a worst case scenario, I guess, that didn't include just exiting leases. That included renegotiating some leases and maybe as importantly, moving some leases onto franchisees. So tenant franchisor was able to get out of the lease, and but the restaurant stayed open with the tenant, the franchisee as tenant.
Interesting. Mark, anything else to add?
Creative times. Creative times.
Right. Yeah, creativity.
Yeah, that's the right word, Larry. Being open, you communicate, being creative. To Lee's point, it's always better to be open and be paying something than closed and paying nothing, for sure, from a landlord perspective. And as these big office towers start to repopulate a little bit, they're going to need services in those buildings to for those people to rely on, walking down and get your lunch or whatever it might be, right? Dry cleaning. So it's really important that we work together to gradually get these things back to some level of normal.
Right. Another question that came in that I thought was really interesting and would like to hear your ideas around it is, related to growing into new markets, or just growing in markets where everything is kind of different. And how do you map out projections? How do you make sort of decisions about whether or not a site makes sense? Sort of curious about that. And Mark, maybe I'll go back to you first, as I know that's probably something you work on every day. What are some of the ideas or some concepts or things that you think about when you're looking at expanding in this new world?
Well, I think from our perspective, we're kind of blessed, Jacob, by having a big footprint across the country. So we have a lot of data. We know kind of who lives in these markets, what they buy, what their trends are. So we kind of know from a baseline perspective at least, will our brands resonate in those communities? It's a good start. And then another strategy that we've talked a lot about is the off-premise kitchen, or the ghost kitchens we call it. I mean, it's a really unique way of testing a brand in a new market for low cost of entry. And even if we or whoever's hosting that facility, brands can come in on a trial basis to see if it does resonate before investing in a big brick and mortar location. So kind of both strategies are working. I think a little bit differently now than they were before. Yeah, but it's really about the data, who lives there, what they're craving, what they spend. Technology and information is more readily available than ever before, and we're utilizing to make better real estate decisions.
Oh, good. Lee or Larry, any other thoughts on that stuff you've seen or heard?
Well, to my mind, it depends a lot on where you are and where you want to go and how far away that is. Working with a lot of franchise companies in the restaurant space, they will rely on their local boots on the ground developer to do a lot of that investigation for them, because that's who's spending the money to build the restaurant. That's who should be satisfied that it's going to work in that market. I mean, a lot of these brands probably don't have the level of sophistication or access to information that Bark's company would have, and that's the way they grow. They rely on those people to do that. But I like that the mention of the ghost kitchen. I know of another brand that is going into new markets that has never been into before, and basically licensing its brand out of the back of someone else's house and just the kitchen. And the Uber Eats driver delivers a package with the brand on it, and that's the first time the brand will be in that market. Maybe it's, again, the future is here now.
Yeah, I mean, we're a large country, Jacob, but we're also a very small country. Brands are pretty well known, and the younger generation that are very brand centric and really flock to brands. So it's hard not to see a commercial or hear an ad on social media and know what the brand is, but you don't see it in your community, and now you can have access to it, right? So it's a very unique way to grow.
Yeah, that's a good point. I think and Lee, I saw you nodding your head as well. Like that, the sort of the ghost kitchen is a way of sort of attacking and getting great in new markets is an interesting approach, right?
It is, yeah. I think Mark's in a unique situation because he can control his brand. If you're a smaller brand to a new market, that could present different challenges. Some of the strategies are tried and tested. I mean, my advice would be make sure you travel the market, touch, feel, see who the consumers are. With that said, consumer behaviors are changing. So one of the things that we've invested in is a good mobile, device tracking system where you can see the heat mapping of where traffic is going and coming from. And that's something we use for our clients to offer them, true COVID pandemic traffic patterns, right? You can see how much traffic is going in intersections versus where it was pre-pandemic. How has that shifted? Looking at demographics of your existing sites, if you're truly transitioning from a major market to another, running radius rings to try to identify similar dynamics, whether it's household income, food spend, population, average age, etc. Those are, some traditional methods, but I think they remain pretty true and tested. They won't change that much with respect to COVID. You need to know your concept and what's working for you that's driven you to have the ability to expand and try to replicate that as best you can.
Interesting. So it's 2:08. So let's do. I think we have time for one more question, and that's going to be, of course, the crystal ball question, right? So it would be great, sort of, if each of you could sort of give me or leave us with one sort of maybe interesting idea or prediction for 2021. And I'll go left to right across my screen. So Mark, I'll start with you.
Yeah, I think we're in a bit of a unique circumstance because we have a wide basket of offerings from QSR to premium. So we're very lucky and blessed that way. We do anticipate it's going to be a fairly slow rebuild in 2021 and likely take the full year to get back to any kind of 2019 levels if we're lucky. That's what we're expecting and planning for. And if it comes back sooner, great. We want to make sure we're being cautiously optimistic, I'd say. And then really trying to accelerate some of those things we talked about, right sizing our locations, creating ease for the new customer type experience, buy online, pick up in store, frictionless, making those areas within our four walls, our restaurants, really accessible and easy to navigate for consumers that are coming in a more non-traditional sense than they were before. And then again, continue to grow our off-premise kitchen look as well. So that's kind of our viewpoint on the world, and and hopefully it'll be better than we're expecting.
Yeah, for sure. Sure. Lee?
A few comments, Jacob. I think real estate will continue to bring restaurant brands closer to their consumer, and it's a fundamental part of delivering your concept to people. So those dynamics, they're going to stay in place in some capacity. So stay close to consumer behavior, watch the customer migrations, and watch it closely. I think that's going to be fundamental in helping us to understand where you need to be going forward, without a doubt. From a concept perspective, resilience is going to run key. I think being one-dimensional as a restaurant is no longer acceptable, and I think landlords are going to be driving that conversation with the future tenants that they choose to invest in, because that's going to be something. If you're joining a new development and they're providing you with a large inducement or any inducement, they're going to really want to be qualifying who they're partnering with in those scenarios. So you can't just sell food as a full service restaurant. You need to think through your aggregator programs and your digital door, a retail offering, whether you're licensing that signature item, whatever it may be. Those are all things to bring to the table when you're trying to win a site over another tenant as well, so that you can prove to a landlord that you are the best in class operator and they should be going with you, whether the market's depressed or not. They're still making that final decision. So celebrate your pivots and communicate them and be resilient.
Right. Great. And Larry, last word.
Well, I agree with everything Mark and Lee said, so I'll focus on sum it up in one word: consolidation. I think at the unit level, you'll see a greater trend towards multi-unit ownership, fewer single unit franchisees, for various reasons, but the better brands even will grow that way, and that's future success. And then consolidation at the top level, at the brand level, as more activity in private equity and M&A. So that's sort of what I sum it up there: consolidation, various levels. Great.
Well, thanks guys. Again, I appreciate the time today. I think it was a good discussion and very insightful, and I'm sure we didn't answer every question and clarify everything, but we maybe gave some people some stuff to think about. So that was awesome, and I appreciate you joining me, guys. Thank you.
Pleasure, Jacob. Thank you.
Thanks.
Yeah, thanks. Pleasure.
So that's it for today. Just a reminder that we do have one more session tomorrow. That's the technology and food service session, and again, you can still register online for that. So again, thank you, Mark and Lee and Larry for joining and for your insights. Thanks you to our sponsors again, and of course thanks to Cassels for sponsoring this particular session. And most importantly, again, thanks to our audience for joining us, and we hope that you enjoyed the session, and hope to see you back tomorrow. So have a great rest of the day, everyone. Thank you.
Thanks, everybody.
Bye-bye.